Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And the odds are that you're watching this video because you got an email from me telling you that it's up and on YouTube. You see, every single trading day before the opening bell, I send out a free email. You can subscribe to it by going below this video to the link. Has links to the top stories of the day you need to know about that are market impacting and a link to my market commentary. Now, this has been a very difficult and challenging year in the financial markets for everybody. In the first 4 or 5 months, we saw a tremendous rally in commodities. The price of gold also surged while the stock market declined. In fact, energy stocks, by the time of their peak a couple months ago, statistically were outperforming everything, every single sector of the market since the April 2020 low. Yes, that means the XL ETF stocks like Exxon went up even more than stocks such as Apple, Netflix, and Facebook by then, because those stocks have been going down substantially while the energy complex was continuing higher. But over the past few months, we've seen a big pullback in the commodity complex too. So at this moment, basically everything is knocked down below its 200-day moving average. And it's very difficult to make money when things are trading below their 200-day moving average for a period of time, because that is essentially what happens in a bear cycle, a decline that's more meaningful than a correction. Now, the price of gold last week dipped below the 1700 level on Friday, around the opening bell, and then bounced back above it. Now, that level has been long-term support for quite some time. And gold is something I own, something I've been investing in with core position, but also trading for 20 years. And when I do the videos I do, I try to be as objective with myself and with you what is going on in the financial markets. Because if you diverge away from the trend, you can get punched in the nose, metaphorically speaking, beaten down financially. We don't want that. We want to beat the market. We want to win in these markets. So what's going on with gold? Since the 20 years I've been trading gold, mining stocks, investing in them, there's one indicator that has been more reliable than any other indicator for timing buys and sells for gold in the mining stocks. That is the GDX divided by GLD relative strength ratio. What this ratio does is it measures the performance of big cap mining stocks, because the GDX ETF is made up of big cap mining stocks, and compares it with the price of gold. And typically what will happen is when gold is making a top, the mining stocks will have already topped out before. The performance of the mining stocks tends to forecast or foreshadow the performance in gold. So if mining stocks decline and gold goes up, that's a bearish signal. In the year 2012, when gold made a very significant peak, and so did the price of silver, and silver was having this big run up for approximately 2 months, went up to like $50 an ounce. The mining stocks did not confirm that move. In fact, many of the mining stocks went down. So the GDX to gold and the GDX silver ratio was declining while silver was making its final peak of that bull cycle. And that signal was in effect for several months. forecasting, warning a mega top. And then gold and silver fell in a bear market for several years, and the mining stocks got crushed, fell, I think 90%, the sector did. One of the biggest bear markets for them ever. Now, that's not what happens every single time the signal gives a warning. But in that case, the warning was going on for months. This ratio can decline and signal a mere correction. So from 2002 to 2009, that signal happened a few times and signaled corrections within a long-term bull trend. Now, this ratio, when gold is correcting and the mining stocks are correcting, if this ratio starts to flatten out or even go up, that's a buy signal. So just as the ratio can signal tops, it also signals bottoms and buying opportunities. This ratio is the single most powerful indicator I have and have found to be the most reliable for timing gold buys and sells, mining stocks buys and sells. So what is this ratio telling us now? That is a critical question when gold has hit 1,700, when gold is corrected off the high, and when it's causing people to be nervous, not wondering what to do. And at the same time, many people are out there in the gold community calling bottoms, calling for a buy opportunity. So what's going on? Let's look at the ratio and see the implications of it. And what does it mean for the broader market? Because that's a huge issue too. So when we look at the ratio, we see that it made a new low on Friday. That's a bearish sign that suggests that the correction in gold or decline in gold and the mining stocks and silver is not over. Even though gold went below 1,700 and came back above it, this ratio says the decline is not over. And I take that very seriously. So while I got long-term gold that I own, I'm not buying more right now. I'm, in fact, being more cautious on the markets, period, than I was even at the beginning of the year when I came into the year 50% long, 50% short. If you've been following, you know that in the summer 2021, I went I built up a 50% cash position, did a lot of selling and went to 50% cash. Then around New Year's, I began to go 50% short, hedging. Now, this is becoming one of the most challenging market environments I've ever seen. And we're going to do more videos about that. But so this is what the ratio is doing. Now let's look at the price of gold. Let's look at the GDX. And you can see the GDX is at 2541. It's below the lows of last year, which was 28. So this is, it didn't make a new low Friday. The ratio made a new low Friday, but GDX, it's in a correction. And I'm not one who tries to predict, what the future price this is going to go to and bottom. Is it going to be 24, 22, 20, or 25? I don't know. I look for the ratio to tell me when the correction or the decline is over. So when that ratio starts to go up while gold continues down, I will take that as a bottom buy signal. And I did a post last weekend, I think it was, about what happened in 2008. In 2008, gold outperformed the stock market while the stock market, was in a bear market. and then just boom, got smashed in August 2008, broke down, and then in the fall, everything crashed. So in 2008, when this ratio broke down, or the GDX broke down, that preceded a significant decline in the stock market. Now, it doesn't mean the stock market is going to crash like it did in 2008, but I do think it suggests that the situation in the market can become even more bearish than what it's been. We're seeing a stock market short-term rally since June that, and last week, the S&P did close above 3,900, which had been a high a few weeks ago. So the short term, that was a positive. But now the daily stochastics are firmly above 80 overbought. Commodities are falling or weak. The GDX is broken down like it did in August 2008. So I think this is going to become a failed rally. And the market's below its 150-day and 200-day moving average, firmly below. And we could even draw a downtrend channel on it now. But so to sum up, the GDX divided by GLD ratio is falling. That's a warning sign that gold is not yet bottom, which has implications for the rest of the stock market, because it's another sign of risk off. In May, the price of silver broke down right here when it fell below 22. Yes, it bounced back up, but then it went below 20. Now it's right above 18. That breakdown in silver was really the warning sign that the sell-off in the stock market was likely to become more of a generalized decline. And I think that's what the GDX divided by GLD ratio is confirming. And why the selling spread in commodities, that yes, even though last week the stock market went up, the overall picture is now more bearish than it was several months ago. Now, everything has the potential to go down. Don't get too excited about the S&P 500 and people look. Here's the problem, and then I want to talk about things I was wrong about and what we need to learn from that. But I just want to make one point first. There's a massive problem in the financial media, whether that's CNBC or people on YouTube, the so-called alternative media. There's a massive problem, and it impacts everybody that's making financial content. I don't care if it's Jim Cramer or myself or Kathy Wood. Everybody is impacted by this. And what it is that when you do a TV program on television, you've got to maintain your audience. You've got to have good ratings. If the ratings collapse, you'll be taken off the air. On YouTube, if you do not deliver content that people want to watch, the algorithm will no longer deliver the content to people. You may have a small niche following of people. They will continue to show the content to that. But when they show the content to new people, if they don't like what you're saying, they click off to find a video they do. YouTube sees that signal and then won't promote your video to others. What this means is that the content being produced will only reach mass numbers of people if it's delivering what the masses want. And what the masses want is stock picks and to be told that the market is going to go up, that they should hold on to what they already got and they're going to be okay. And someone giving new buys implies that. So the type of what I'm telling you, very few people are willing to come out and say it. And if they do, you're unlikely to even see it. The message isn't going to spread because of the way the algorithms are designed. So only, it would be shocking if 1,000 people watch this video. Almost all the viewers are coming from my own website. So what I'm trying to say is that it's in a way it makes it difficult to navigate these markets because you are being bombarded by bullish messaging because that's what people want to hear, and it's an echo chamber. And when I think the prudent thing to be is cautious, more cautious now than you may have been earlier. And that's what I'm doing myself. And these markets have fooled people. Most people thought the stock market was going to do fine this year. There are boundless predictions that inflation wasn't going to be a problem. Think back to the first quarter of 2021. Jerome Powell and so-called alternative financial media people who were echoing him were saying inflation would go away. It was temporary, and now it's made a new record even last month and on an annualized basis from what it was. So all the predictions were wrong, and we're facing higher interest rates than people had expected, and it's hurting everything. And that's why probably commodities and gold are getting whacked because the rate of interest rate hikes is has not peaked out. It will at some point, but that's not happening right now. So here's the thing, though, where I was right and where I've been wrong. In 2020, we saw the Federal Reserve take rates to zero. We saw a secular bottom in commodities. This is the CRB index when the price of oil went negative. And this is still a powerful secular uptrend. Even if the CRB index went to 240 or 220, it can, that it's cyclical. That would be a cyclical bear and a secular bull. And I'm still long-term bullish on commodities and gold and silver and oil, even if they're pulling back now, which they seem to be doing. But I thought, look, the Fed took rates to zero, debt's exploding, commodities are making a secular bottom. I thought we're likely to enter a market environment similar to the 1970s. And that was characterized by high inflation, and the best sectors to invest in were gold, energy, materials, commodity-related sectors. And that's how I positioned myself. And now we're having a correction in those sectors. But as this year came, and if you modeled it to the 70s, the situation seemed to be very similar to what happened in 1974. And it was up until recently. And the Federal Reserve itself, in the past 6 weeks, has also cited 1974 as a situation that it was closely following and tracking. But this dip in gold and silver is not what happened in 1974. In 1974, the stock market fell all year, but gold and silver and mining stocks pretty much went up all year. This decline that's happened now in gold and silver did not happen in 1974. So that suggests that the 1974 model is not exactly repeating here. So what is happening? Well, we got to do a follow-up video about 1974, what exactly happened then, and what the Fed is reacting to and trying to avoid to understand what they're doing, what's happening. And if that model is not exactly happening, then we got to look at past models. No model is going to exactly be the same, but we need to draw lessons from the past to understand what's happening now, because we're in a completely different market environment than any that we've lived through, that's ever existed since 1999, since the 90s. And I'm going to talk about this in some follow-up videos. I'm going to talk about in a video why the market is not trading anywhere like it ever has in the past since 1980, much less 1995. Completely different market environment. And that has implications. We've got to dig down into all these things and understand them to adjust, to adapt, to navigate these markets, not just this year, but the next 10 years. And that's what I'm here to help you do. Now, I'm going to put out a video Tuesday about why the market's different now than it has been. And then we're going to follow up with other videos about past market cycles, about 1974, and really get going. Now, I took anyway, so if you enjoy this sort of content, find it valuable, hit the like button, and YouTube will know, hey, there are people out there that like it. So we will show it to a few other people like them. And then hit the subscribe button if you're new to me, and then YouTube will send you an alert as soon as the next video is up. And I'll be talking with you later.